Something unusual is happening in the financial markets. Gold and stocks are reaching all-time highs at the same time. That coincidence has not occurred in decades. It only happened twice in 1972, and that time the outcome behind that coincidence was not positive. However, so far in 2025, there have already been 6 occasions in which both assets closed at new all-time highs on the same day, something unprecedented in recent history. Usually, gold rises in times of economic fear, while stocks rise with economic optimism. That is why both rising simultaneously suggests that signals of fear and confidence have mixed, and something out of the ordinary is happening. So the questions are, why are gold and stocks rising at the same time? And what does this have to do with people's confidence in governments? So far in 2025, gold has accumulated a 44% increase. That is, gold has reached a record price above $3,800 per ounce, while many global stock indicators have touched highs or are near them. For example, the world's most important stock index, the S&P 500, which includes the 500 largest companies in the United States by market capitalization, recently reached an all-time high. But this, as we mentioned, is very strange because historically gold and stocks usually move in opposite directions. In other words, gold and stocks have historically been natural enemies. Gold rises when there is fear, inflation, or crisis because investors seek safety in an asset that does not depend on banks or governments. On the contrary, stocks rise when there is economic optimism because companies earn more money and investors trust growth. For example, during the 2008 crisis, gold rose by more than 100% while stock markets collapsed. In contrast, during the tech boom between 2010 and 2019, stock markets rose strongly while gold remained stable or fell. So why is this so unusual? Gold and stocks are rising at the same time mainly for 2 reasons. The first is that there is mixed sentiment and uncertainty. In other words, investors are covering their backs. Faced with an uncertain outlook with global conflicts and trade wars, they choose to position themselves for greater future risk, so they decide to buy gold. But at the same time, they are positioning for growth, expecting interest rate cuts from central banks. So they buy stocks in anticipation of positive economic prospects. In short, gold is considered a safe haven and usually performs better when prospects are not the best, while stocks rise when the environment seems favorable. That both rise at the same time indicates that uncertainty prevails, and there is no clear consensus on the economic future, so there are both defensive and offensive bets in investors' portfolios. The second factor is that the US dollar is weakening. The DXY is an index that compares the US dollar against the 6 most important currencies, and it fell by 11% in the first half of 2025. In other words, the dollar is losing value. This has 2 effects. The first is that since gold is priced in dollars, if the dollar weakens, gold becomes cheaper for foreigners who use other currencies, which increases the demand for gold from outside the United States, making its price rise. And at the same time, a weaker dollar makes US stocks cheaper for foreign buyers, which benefits stock indices. In summary, we have mentioned that gold and stocks rise at the same time due to a weak dollar and uncertainty. Now then, what does this have to do with the loss of confidence in governments and fiat money? This video is brought to you thanks to the sponsorship of Sectorial. Sectorial monitors more than 700 information sources daily to map the dynamics of your sector, identify regulatory changes, business opportunities, and facilitate well-informed decision-making. To learn more, visit www.sectorialcu.com. For decades, money issued by governments was a synonym of stability, because until 1971 most of the world's currencies were tied to the gold standard. This limited the amount of money a central bank could print, since it could not print more bills without first having the gold to back that new money. This restriction provided confidence and stability because the value of money did not depend on political decisions, but on a scarce asset like gold. In addition, after the 2 world wars, Western governments applied prudent spending and debt policies. That is, fiscal deficits were low, inflation remained controlled, and central banks were not yet intervening massively by buying public debt. That is why people trusted that their money would maintain its purchasing power the following year. However, confidence began to fall starting in 1971 when Richard Nixon, President of the United States, eliminated the dollar-gold standard system, and since then governments have not needed gold to print money. Therefore, public spending increased and global debt exceeded 100% of global GDP. This is why it is not surprising that individuals and central banks prefer gold, stocks, or even Bitcoin, assets that, unlike fiat currencies, cannot be manipulated at the will of the government. Thus, the massive printing of money and growing debts have been deteriorating the purchasing power of currencies like the dollar. For example, after abandoning the gold standard in 1971, $1,000 in the United States at that time bought 25 ounces of gold. Today, it barely buys 0.25 ounces. In other words, the dollar has lost 99% of its value in terms of gold in the last 50 years. So, seen from another point of view, it may not be gold that is rising, but fiat money losing value, because there is no longer a physical backing like gold when printing currency. Only the collective confidence in that paper printed by central banks. So when there is irresponsible handling of a currency by a state, such as uncontrolled debt, high public spending, or massive expansion of money, citizens or investors lose confidence in the control of fiat money by governments. And that is when they decide to move toward non-state assets such as gold, Bitcoin, or shares of large companies. In fact, the fall in confidence in governments has been such that companies are seen with greater trust. For example, a widely cited study measuring public trust in institutions found that globally 62% of respondents trusted companies and 51% trusted governments. This does not mean an absolute preference for companies, but it does show that more people are willing to trust companies more than governments. Some investment funds are even selling assets exclusively linked to the government because state debt is at unsustainable levels. Normally, in times of uncertainty, large funds take refuge in government bonds. That is, they lend money to governments. However, the opposite is happening. For example, PIMCO, one of the largest investment managers in the world, announced that it was moving away from U.S. debt bonds due to the country's low fiscal sustainability. Its executives stated that they prefer short and medium-term treasury bonds, but avoid long-term ones due to the risk of higher inflation and massive debt issuance to finance deficits. In other words, they limit their investment in government bonds because they fear a possible risk that the government may not be able to pay its debt or that it may restructure it. But as we mentioned, if government credibility falls, capital migrates to wherever greater confidence is perceived. And today, companies inspire more confidence than states in many ways. And it is no surprise. Some corporations even show better financial solvency than entire countries. For example, Johnson & Johnson and Microsoft are currently two companies with AAA credit ratings, the highest possible. On the contrary, the United States no longer has a AAA rating from two risk rating agencies due to its fiscal imbalances. This means that, in the opinion of ratings agencies, these companies have lower risk of default than the U.S. government itself. In conclusion, people are seeking refuge in what is tangible and in real productivity, while fiat currencies lose credibility in the face of growing fiscal debt and inflation. That is why if governments do not recover fiscal discipline as in the past, capital may continue moving towards stocks, gold, and Bitcoin. That's the end of the video, and thank you very much for making it to the end.